Now, 904D is a terribly long subsection, and it gets very, very involved, and it's probably the cause of more headaches in corporations than most other issues. So why is it there? And we'll attempt to spend a little bit of time trying to understand a little bit of what it does. So the first question is, why is it there? I refer to it as an exercise in self-flagellation, which I think is reasonably accurate, unfortunately. If we look back, let's say to the 1950s and 60s, there was, after World War II, in a sense, a great increase in the amount of business that U.S. companies were trying to conduct in Europe. And a lot of those countries had very, very high tax rates, sometimes higher than the U.S. rates. So it happened very often that companies would have excess foreign tax credits. Or individuals might have excess foreign tax credits. Now, if you have excess foreign tax credits, your goal in life is to see if you can't somehow earn some income, which you'd be earning anyway, but earn some income which you can characterize as foreign source instead of domestic source, so that you can utilize those excess foreign tax credits. I save a little bit, from my University of Washington paycheck, each month. Not that much, but a little bit. And if I go down to my home street bank, or for those of you who use the big boys, Bank of America, or whoever, and I put my money in, I'm going to earn interest. And because I'm trying to be fiscally responsible and save a little money for my retirement, I'm going to be doing that. Each month I'm going to put a little money away, and I'll earn a little interest. And each year I calculate how much interest I have, and I'm taxed on it by the U.S. government. Well, that's nothing unusual. I think that happens to you as well. You have some interest income? No. Sorry to hear that. Well, hopefully you will have at some point in your future. Okay. Now, interest income is a nice example. Why? Because I could choose to open a bank account in Canada. Would not be too difficult. I could drive up and visit a Canadian bank and put my $7.30 that I save each month, or whatever it is, into a Canadian bank. Does a Canadian bank pay interest to me, which is foreign source or U.S. source? Anybody remember the rules for sourcing of interest income? Pardon? You've got to speak up louder, Ricardo. Project.
It's under the exemption, right? So we're not Canadian bank, so
Yeah, I'm earning interest from a Canadian bank. I think you're thinking the other direction. In other words, if a Canadian were to earn interest from a U.S. bank. Okay, but now I'm an American earning interest from a Canadian bank on my first deposit of $7.30. Now, will Canada tax that interest income to me? Yeah, maybe they will. If I remember correctly, I think back in the 50s and 60s, they had a 5% withholding tax on interest. I think that was it, but I may be wrong. The point is that if I have foreign tax credits, excess foreign tax credits, and I can choose to take my money out of my local Home Street Bank in Seattle and put that money into a Canadian bank instead, and now all of a sudden, hey, I no longer have to pay the U.S. any tax on my interest income because it's foreign source. It goes into the foreign tax credit limitation formula, and I can use my excess credits, and now I pay no U.S. tax on my interest income. It's pretty easy to move money. So in the 1950s, when these companies were opening up branches and operations in Europe and paying very high tax, they realized, gee, we've got all of this excess foreign tax credits, and we need to convert anything that we can, any income that we can, from U.S. source to foreign source. So, gee, let's put all of our bank balances, these big corporations, into Canadian banks or elsewhere around the world. And from an economic standpoint, this became a big balance of payments problem for the U.S. So all this money was exiting the U.S. banking system. So partially due to lobbying from U.S. banks, partly from the Treasury realizing that there was something theoretically wrong with this, the first basket was non-business interest income. And the effect was that they said, okay, we'll have two applications of that formula. Instead of an overall foreign source taxable income, considering all income in the company or for the individual, you had to apply the rule twice. Had to apply the formula twice. Once, only for non-business interest income, where that formula would be, of course, my foreign source non-business interest income over my worldwide taxable income times my U.S. tax before credits, and that would give whatever number it gave. And I would compare that to the actual, in this, assuming it was 5% coming from Canada, I'd compare that limitation number to how much tax I had paid to Canada through withholding on the interest. And whichever number was lower, that became my foreign tax credit. Because remember, your foreign tax credit, in this case on non-business interest income, is the lower of the limitation I just calculated or the actual tax I paid on that non-business interest income. And then the second application of the formula is everything else. All business income, dividends, any other items. It was only non-business interest because the focus was it's easy to move money to foreign bank accounts. Let's just focus on non-business interest income. So we had our first basket. And that meant when we went to do the all other income, in other words, everything other than non-business interest income, we ended up with no ability to use those excess foreign tax credits against the non-business interest income. The foreign source taxable income would be everything else and would not include the foreign source non-business interest. And so this was the mechanism they came up with. Two different calculations, two different applications of the formula. Now, obviously, over time, there has been increasing mechanisms for foreign companies to invest, or for investment bankers to come up with ideas as to how to get around these rules. So, just as a simple example, one of the things that happened immediately after these rules came into effect was that somebody formed a company, let's say in the Cayman Islands, and would sell to anybody who was looking for a place to earn what was economically interest income that would be foreign source. They formed a Cayman company, and then from the invested money, they of course invested it into bank accounts and perhaps other short-term securities. They could be U.S. Treasuries or others. Now, this, from the perspective of the investors out here, this is a dividend that they are getting. Or perhaps if it's if they are redeemed out at some point, or the whole thing is liquidated at some point, maybe they have capital gain, or maybe they sell it and they realize capital gain, they sell their interest. But the point is that because the rule at that time was only foreign source non-business interest, why, I'm not sure whether they're wise, but at least creative people quickly came up with a substitute that would economically get these investors out here, which were primarily large corporations at that time, and perhaps some individuals as well, to get them dividend income, which was foreign source because it was paid by a foreign company. And again, you go back to your source rules on how do you tell what is the source of a dividend, and it's going to be, if it's a company incorporated in the Cayman Islands, under normal circumstances, it will be foreign source. So this was the kinds of things that companies were doing, and you needed tax rules to, that slowly evolved over time to get at these issues and to correct them, so to speak. So today, if you go through 904D and some of the other parts of 904, the sourcing rules, you see a number of mechanisms which are trying to get at these kinds of situations, the mechanisms that that creative investment bankers and others have come up with to try to circumvent whatever the rule of the day happens to be. And as I said during the first class session, this is one of the reasons why there's so much complication in the code. Somewhere in the outline, I think I've mentioned a subsection that that today would take all of this income that's U.S. source and characterize it for anybody who's able to ultimately take a foreign tax credit, assuming a 10% ownership, so there's a deemed paid credit, and characterize it as U.S. source instead of foreign source. So a lot of this complication is coming from the ingenuity and creativity that people have. There has been a tremendous amount of evolution in this 904D area. I think I mentioned last week that at various times the U.S. has had a country-by-country limitation. We've also had changes in how many baskets there are. It started simply with non-business interest income, and it got up to 9 baskets within the section. And technically, there was an unlimited number of baskets because, for example, one of the baskets was a separate limitation computation for any investment that a U.S. corporation had in a foreign company that was owned 10 to 50%. So, and that was also not a CFC. And I frankly don't remember as to why that made sense to do at the time, but they got rid of it eventually with the changes in 2004. So we're back down to 2 baskets. This is intended to simplify. A lot of the things that define baskets from before are actually still in the rules, so I'm not sure that it really reduced the complexity of the various calculations, but at least at the end of the day, we're only concerned with 2 baskets. And we'll, again, talk a little bit more about what those are. Okay, as you can see, we're looking at the 2 baskets being referred to as the passive basket and the general basket. And the general really means everything that's not passive. So the way this thing is defined, detailed rules on what's passive, and everything else is the general basket. Now, we have not covered subpart F yet. We'll hopefully start that a little later this evening. But notice that when we look at the code section in 904D that defines passive income, it's a nice it's a nice easy reference to foreign personal holding company income in the subpart F rules. So that refers to 954C, which is where foreign personal holding company income is defined. And there are a number of items defined within that. And as you can see, there's no surprise, I would say, in seeing dividends, interest, and annuities, royalties and rents, net gains from sale or exchange of property, property that gives rise to dividends, interest, royalties, things like that. Commodity transactions, notional principal contracts, in other words, swaps and options, that sort of income from derivatives. Foreign currency gains is one of the categories. And then lastly, amounts received under personal service contracts, and we'll talk more about what that is another time. But if you think about these types of income, generally there's not a lot of surprise. I mean, this is not your normal day-to-day business income. Now, as you go through 904, as you read through 904D, of course, you find some items in there. And the first one, which you'll find, is this high taxed income exception. Okay, why is that there? Let's say you have an item of passive income. Or, I'm sorry, let me step back a moment. Passive income, by its nature, very often will have less tax on it than active business income. Now, why do I say that? A lot of the passive income will be subject maybe to withholding taxes, which are a lower rate generally than the normal rate on active business income. The nature of a lot of these types of income is that there's not a lot of expenses associated with it. True royalties, you may, of course, have incurred expense in creating a patent or buying the patent. So in theory, maybe you have some depreciation, but you probably, if you created it, you probably expensed the cost of that long ago. So whatever royalty income you're receiving has little, if any, expenses. So if you're subject to a 10% withholding tax, relatively speaking, that's a low tax in comparison with the tax rate applicable to your normal business income. So I think we can say, as a general rule, passive income usually is not taxed as high as active business income. Now, if you happen to have a particular item of passive income which is highly taxed, and you have a lot of passive income which is taxed relatively low, well, gee, that sounds great. Because if they're all in one basket, you can use those excess credits from the high tax passive income against the income that was only subject to a low foreign tax. You can offset them. Gee, that sounds really nice. Well, somebody who was writing trying to draft this original basket situation said, well, gee, we shouldn't be giving people that benefit. We shouldn't be giving people who earn high-taxed passive income the ability to average. So they said, anything that is high-taxed, we will move over to the general basket. And how do we know if something's high-taxed? Well, if it has a foreign tax which is equal to or more than, I think it was more than as opposed to equal to, but anyway, the U.S. tax rates. So, as it says, generally any income subject to foreign taxes at an effective rate that is higher than the applicable Section 1 for individuals or Section 11 for corporations tax rate. So again, that's your 35%. And again, that's the foreign tax. When you look at this, it's an effective tax rate. Because, again, maybe you have a withholding on gross, and you have to calculate the net income from that gross income to know whether you're at 35% or 40 or 20 or whatever. So you've got to go through transaction by transaction, income item by income item analysis on this. And this is terrible. Yeah.
I'm not sure about that. So if you're taxed on, foreign country taxes you on gross, you go ahead and factor in all your expenses and determine net and determine your effective tax rate.
Exactly. Yeah, exactly. I mean, so as you think about this, you know, it's bad enough for an individual to go through this kind of stuff. I mean, again, think about a large corporation that has, you know, its hands all over the world, all sorts of different kinds of things that they're getting into. I mean, this is a massive computation. When I say terrible, it really is, and it's a major amount of, in a sense, salary cost used just to be able to figure out what the tax is. The next item down here, the look-through rules. Now, before we talk about exactly what that is, it occurs to me that I should attempt to draw a picture or two and attempt to make sure that we're all on the same page, so to speak, in terms of understanding this. Let's say that we have X in the U.S. and this is country A, and let's say this is Y. We'll assume it's a 100% subsidiary. Now, if X forms Y with well, X, of course, would form Y with some amount of equity. So if there's equity, then, of course, there's a mechanism for future dividend payments. So one kind of payment that Y may make to X, of course, is dividends. X might loan money to Y. So maybe we have a loan. And if we have a loan, we're going to have interest payments. Maybe X licenses technology to Y, in which case we're going to have a royalty payment. Let's assume in this example that Y, that its activities are all active business, legitimate active business activities. Active business. That's all of its income. Remember that when we defined passive income, we looked to the subpart F rules, the foreign personal holding company income as defined, and we said that included dividends, interest, rents, royalties, annuities, et cetera, et cetera. So under the general rule, if X is receiving dividends, royalty, interest, those by definition are all passive items. That's the general rule. Now, there can be legitimate reasons why X chooses to have Y as in subsidiary form. Okay. What if instead of having the subsidiary, what if X chose to operate in country A as through a branch instead of a subsidiary? Still the same business activities. X is still providing the same financing because the branch has the business of the branch has the same capital needs that in the earlier case were satisfied by equity and a loan. The operations of the branch, of course, need the whatever that intellectual property is that was licensed, but because this is X itself that is operating through a branch, so it already has that right. You don't need to have a license agreement. So in this case, there's going to be branch profits and maybe later a remittance of branch profits. But there's no need, there is legally no dividend. There's legally no interest. There's legally no royalty. Now, because all of the activities of that branch are business activities that would be in that general category, then we know that whatever net income is going to go eventually into that foreign source taxable income number, all of it's going to be general income. All of it's going to be in the general basket. But here, where we have this other situation, all of a sudden, our general rule says X is only receiving passive income. So we're getting, if we only use that general rule, a different answer between operating as a branch and operating in subsidiary form. So if we're getting a different answer because of a structural thing like that, as you might imagine, policymakers who are trying to say, well, gee, people should be making their decisions not based on taxation, but based on legitimate business need, we need a mechanism to correct this. So, as a result, with respect to the dividend, with respect to the interest, with respect to the royalty, there's a look-through rule. So instead of applying just the general rule that this is passive, we look to the activity of the CFC from which we are getting that dividend, that interest, that royalty. We look to the activity of Y, and we proportionally figure out how much of the activity of Y was, itself earned passive income, how much of the activity of Y was active business income, and that governs the character of the dividend for purposes of this passive versus general classification. And for royalty, and the same rule applies for interest, because money is fungible. But for the royalty, well, how was that intellectual property used? Intellectual property, let's say, was used only in an active business. So that would come through, you'd look through and you'd say, okay, that's active, then therefore it's part of the general basket. It's not passive. On the other hand, if Y used that intellectual property for a sub-license to somebody else and itself earned royalty income, and depending on the nature of its activities, let's assume that that royalty would be, under these principles, passive income to Y, then that royalty is passive income is in the passive basket for X. So you needed a mechanism to be able to look through to the activities that a CFC actually performs. And this is why you have these flow-through rules. Yes?
So intercompany, like a royalty to the parent, that's ignored?
No, I didn't say it's ignored. What it is that you look at the royalty and you say, okay, what did that royalty, in a sense, get paid out of? What happened within within Y, the CFC subsidiary? What happened within Y that generated that royalty? In other words, what was the income out of which that royalty was paid? Yes.
Yeah, I think also what happens in some cases with large U.S. corporations is that they tend to play a game with the relative value of the IP that goes over to Y. In other words, you spend a lot of money developing IP in Silicon Valley, and Y is operating in Ireland, and they say, then they say, well, this royalty's not really worth very much, so Y doesn't have to pay me very much, and they can go over and operate in Europe and have this kind of low cost of goods. And then the question is, well, what was the true value of that IP, and how do you place a number on that? And that's a hard one to argue in many cases.
Yeah, actually, it's premature. We'll be getting into what you're bringing up later on, a little bit in the context of the subpart F rules, and then more so when we get to transfer pricing. So you're absolutely right. Very often there's a question of, is the royalty adequate? But that's a different issue than at least this one we're looking at right now. Here, whether it's adequate or not, when we do our foreign tax credit limitation, we need to deal with this in a particular manner. And again, this look-through rule is there in order to essentially equate the operation through a subsidiary with the operation directly through a branch. And remember, last week we talked a lot about the deemed paid tax credit. This becomes important in the calculation, of course, of the deemed paid credit at the X level when a dividend is paid, for the dividend piece. For the interest and royalty piece, those are amounts that are paid annually. And as a result, it's something that you have to calculate, each year when there's a payment. Dividends may be paid, may not be paid. There's also a look-through rule, that goes into something that's referred to as a non-controlled 902 corporation. This is one where you have something which is not a CFC, and the ownership is between 10 and 50%. Okay, why is the ownership on this one between 10 and 50%? Why did they choose those numbers? If it was below, if the ownership was below 10%, would we care? Or let's put it this way. Where is the threshold for the deemed paid credit of 902? 10%. Okay, and why do you remember what we said last time about that 10% amount and also a 5% amount for lower tiers? Where that number came from? We said it was an arbitrary number which maybe in theory says, well, gee, if there's 10% or above, there's some sort of maybe influence on management or what have you. But below 10% is really just a portfolio income item, a portfolio investment. So that's where the 10% comes from. You have to have 10% for 902 to apply, and 902 was your deemed paid tax credit. And if you went above 50%, then it would be a controlled foreign corporation. And those other rules that we just talked about, which is 904D3, those rules would apply because it's a CFC. But if it's 50% exactly, it's not a controlled foreign corporation, which again is something we're going to talk about a little later. And these particular rules apply. So this one only focuses on dividends, actual dividends, and again you have the same proportionality of, well, what did that Y company, which is owned 10 to 50%, what did that Y company earn? And then the dividend is characterized as passive or general basket based on its activities. And that also means that any royalty or interest from such a company will be passive because there's no exception. There's no look-through for those other items. It's only the dividend which there's a look-through rule on this one. I encourage you to look through the, through the slides and see some of these other, some of these other things. This particular one, I will say a couple of words about, and that is that you can have a foreign tax where there's no foreign source income. Okay, what do I mean by that? Let's say that we have a situation with where a U.S. person is earning service. This is, I think, one of the best examples, is performing services for a client in another country. And under U.S. rules, we source the services based on where we perform the services. On the other hand, the country of the client may source that as if it's a royalty and say, gee, we want a withholding tax on the amount that's paid. So we have a foreign tax, but as far as the U.S. is concerned, there's no foreign source income. Now, if we look at only this particular item, we say, gee, this is terrible, this is double taxation because we have no foreign tax credit, there's no foreign source income. But again, in the real world, where you have a lot of different, a large company with many different types of income, maybe they, because of other activities that generate foreign source income, maybe they do have excess foreign tax credit limitation, and they are able to use those credits that arise on income which is U.S. source under U.S. rules. So the question becomes, well, which basket does this tax go in? Because if the income is U.S. source, well, you don't have any foreign source income to decide which basket to put it in. So the basic thing is you look at the nature of the income and then put the tax in the same basket that the income would be in if it were foreign source. So understand that you can have that kind of situation. Now, the purpose of this, and I believe the following slide, is to show that the way this look-through rule that we talked about operates, it actually encourages U.S. persons to do planning that will decrease the foreign taxes in the other country. Okay, so what do I mean by that? And we'll compare two situations. Okay, U.S. parent owns a subsidiary in country A and will assume a 40% tax rate. And situation one is that P capitalizes S solely with equity, solely share capital. And in situation two, P capitalizes S partly with equity, which we've said is 600, and partly with debt, which is 400. So the same number of dollars flowing down into the subsidiary, but needless to say, structured in a different manner. Now, as a result of there being, in the second situation, as a result of there being interest, if we're assuming in both situations, as we are, that the amount of income from their real operations is the same, in the second situation there will be an interest expense that there's not in the first situation. So the actual taxable income, the net income in the second situation, is lower by the amount of the interest. And if taxable income is lower, well, the tax is lower. Now, I've said a few times that typically when interest or royalty is paid, if there's a withholding tax, usually the rate of tax is lower than the generally applicable tax on net income in the country. So if the normal rate on net income is 40%, generally the withholding tax on a payment of interest or dividends is normally going to be lower. So we are assuming in this case that, I assumed that there was no withholding tax in this, but the point is if the subsidiary S is getting a deduction for 20 against income which is taxed at 40%, and then has a withholding tax, whether it's 0 or 10 or 20 or whatever, which is less than the 40, then the total taxes which are paid to country A is going to be less as a result of the interest or royalty that's being paid. Because interest and royalty are generally tax deductions. So we're reducing the tax within S in the case of, let's say, that 20 of interest. We're reducing the tax in S by 40% of that 20, which is 8, and we're only increasing the tax by whatever withholding tax there is on the interest payment. So we end up with a lower amount in total paid to country A. Now, because of the look-through rule for that interest, we end up with the same general basket characterization of that interest income and general basket characterization of any dividend that's paid. So we end up with the same U.S. answer in terms of what's the total amount of foreign tax credit limitation allowed, but we've reduced the total country A tax. So this is a mechanism which encourages U.S. persons to attempt to structure their subsidiaries in a manner which reduces their subsidiaries' tax in that country. Now, interestingly, again, we'll get to something later where the U.S. rules are actually quite inconsistent. Here, there is a very, very clear encouragement of tax planning to minimize foreign taxes. In another area that we'll see, which is the branch rule under subpart F for foreign-based company sales income, we will find that it's the exact opposite. If you try to reduce your foreign tax, you may get hit on the head as a result. So there's not necessarily consistency here. But in any case, this is again an important example of how things apply and how companies are encouraged to do one thing or another because of the way these tax rules are. I apologize that this doesn't feel as clear as I would like it to be, but the basic thing is that if you structure items, structure flows which are deductible at the subsidiary level, that are deductible, that generally reduces overall the amount of foreign tax that's paid. And if you're in an excess credit position especially, that's a very major benefit to you. And because of the look-through rules, you aren't hurt by doing this. You're going to be better off.